This video is the part 1 of the options learning. I will try to cover the what, why and the terminologies. It's not hard as you think. Once you know the fundamentals, it will be easy learn as we go. Relax and take notes or watch this video a few times and you should be able to get the concept. What is options contract? Options give buyers the right, but not the obligation to buy or sell an underlying stock or asset at an agreed upon price and date. I know, it might look like the Google search wordings, but let me explain each and everything very clearly in this video. Let's see, what's an option by itself? It's an asset by itself, but with a date of expiry. It can be sold or bought by anyone. This asset can't be held beyond the expiry date and needs to be either sold, exercised or it gets expired. Option itself is a derived asset, similar to ETFs. Options value is purely dependent on the underlying asset like stocks or bonds. Or, it could another derivative like ETFs. ETFs can have underlying securities in itself. The contract will have all the details like ticker, contract expiry date, strike price, etc. Let's see an example. The contract can be written for a security like Apple, or the contract can be written for a derivatise like SPY, which in turn have Apple, Microsoft, Amazon, etc. An option contract for Apple will have ticker symbol AAPL, strike price for which the contract is sold, expiry date till which the buyer agreed to hold it. Option type is call or put. We'll get into the details of these very soon. Similarly, an option contract for SPY will have ticker symbol, strike price, expiry date and option type. We'll walk you through rest of the video with Apple contract. As you saw, we had two types of option: call contract and put contract. Let's look into the details of the call contract first. I will walk you through few scenarios. Case 1, Apple price stays the same at expiry date. Case 2, Apple price moves above strike price. Case 3, Apple price drops below strike price. The reason I am walking you through with these scenarios, so you will be able to digest the options contract in an easier way. Like any trading, we need both the seller and the buyer. Here, when the seller is writing or selling the call contract, the seller is bearish on the stock, whereas the contract buyer is bullish on the stock. The contract was made on December 23rd. The seller is writing a contract for Apple with a strike price of $130, which will expire on December 30th. The buyer agreed to buy the contract, but here the buyer needs to pay the premium for this contract. With this contract exchange, the buyer is now having the right to buy the Apple share at $130, but not obligated. Let's continue. Few notes to point out here. The seller must own 100 Apple shares to write the call contract. This is covered call. But the seller can still write a call contract without owning 100 Apple shares. They are called naked call. But it's a very risky one. Not going to go deeper into those details in this video. Seller collects the premium of $300. On the buyer side, the buyer just pays the premium of $300 and just holds the contract. Let's go through case 1. Apple price stays the same at expiry date. Let's see if the contract buyer was holding the contract till the expiry date. Since the price closed as the same price as the strike price, the seller holds the 100 shares and also take away the $300 premium. But, since the price is same as strike price, the contract buyer can't exercise it. Maybe the buyer should have done different action during this period? Let's see the alternate option where the buyer could have sold or transferred the contract to someone else. Price could have moved up or down during this period. Assume if the buyer sold the contract to some else at $135, then the buyer could have made some profit. Else, the buyer sold the contract at $125, the buyer could have lost most of the premium or saved some loss based on other factors, which is not in the scope of this video. Since the holder of the contract at expiry is now someone else, then the current holder will lose the premium paid for since the holder can't exercise at the money expiry. ATM is one of the terms used in the options world. One point to note here: the original contract seller was not involved in the intermediate transaction. The contract can move between multiple holders until it expires. At the expiry, the original contract seller and the current holder finishes the transaction. Let's jump to case 2. Apple price moves above strike price. Exact same contract, but let's see if the buyer waits till the expiry, what happens? In this case, seller will lose 100 Apple shares if the buyer decides to exercise, which will be mostly the case. Also, if the seller purchased the Apple share at $130. Then the seller makes $300 profit. If the seller purchased the share at higher than the strike price, then the seller will lose money on this trade. The buyer without exercising means does not get anything. If the buyer exercised the shares, then the buyer takes the profit. Assume if the Apple share closes at $140. Since one contract is 100 shares, and the strike price was $130. The total cost for the buyer to own 100 Apple shares is $13,000 minus the premium $300, which is $12,700. If the buyer sells the shares immediately, the buyer makes $1,300 as profit. Let's see if the buyer did not hold till expiry. If the buyer decides to sell or transfer the contract to someone else, at each stage, the buyer might have made some profit, but it's purely based on the underlying fundamentals, again which is not covered in this video. But the final holder at the expiry will have the option to exercise and make profit. In all scenario, the buyer here may make the profit. In summary, for case 2, contract seller may not be very happy or totally upset based on the strike price and the initial buy price. The initial contract buyer or intermediate buyers might have made some profit. And the final holder may also make profit by exercising based on the contract price. Case 3. Apple price drops below strike price. Since the buyer is bullish, any drop on the stock price will make the buyer lose money if the buyer waits till expiry. But if the buyer decides to exit before the expiry date, there is a possibility to make profit based on the price movement and the underlying fundamentals. The final contract holder for sure is losing the money, since it's out of the money. By this time, you might have learned about at the money, which is case 1, in the money, which is case 2, and out of the money, which is case 3. Each will be discussed in later part. But for now, I think you might have got a very decent idea about the call contract and how it favors the seller or the buyer based on the price movement. Let's now look into the put contract. Here also we will have the same scenario, but I will walk you through just case 3, which is in the buyer's favor. It's exactly the reverse of the call contract. The seller here is bullish on the stock, but the buyer is bearish on the stock. Case 1 is basically similar to buy contract and no change, but case 2 and case 3 is reversed. Case 1 and case 2 are in favor of seller, whereas case 3 is in favor of buyer. Let's now look into case 3. Apple price drops below strike price. The same wait time will make the seller more money. The reason is, for the put contract, the seller can sell the stock at the strike price irrespective of how low the current stock price is. In this case, even though the price is at $120, the seller can sell his stock at $130 and make profit. By now, I think you might have gotten a fair idea about call and put contract terminologies and what is meant by rights versus obligated. The next part will give more insights into how it works in real time with applying all the learned concepts here. But before that, let me summarize in one graph, which will be very useful. In this graph, we have buy and sell on the y-axis, call and put on the x-axis. As a seller, if you think the price movement will be same or will drop, then you have to sell a call contract. If you think if the prices is going to be same or go up, then you have to sell a put contract. As a buyer, if you think the stock will go up very high, then buy a call contract. If it's going to drop very much, then buy a put contract. As a buyer, you pay premium. As a seller, you collect premium. Also, the quadrants shows the bearish and bullish trends. You can use this graph as reference for trading the right contract. Now let's recap the options contract definition. If you read it now, you should be able to understand it better than when you started this video. One final wrap up on this session. Why do you even want to trade options, given its risk and volatility? Risk management. You can use this to hedge against your position, like buying a put contract if you think the stock you have will go lower. Leverage. Using very less premium, you can have a control of larger position of the high-valued stocks. Income generation. As a seller, since you are collecting premium, which can be done recursively when done right. Speculation. Based on some speculation, you can make more money with less investment. Diversification. This is another way to diversify your investment. Hope you enjoyed the video. Please subscribe to my channel if you like to watch similar videos and help my channel. Thank you. See you in another video.